Construction companies go bankrupt every year, and it's usually not because they can't find work. It's because debt, equipment loans, payroll, and cash flow slowly squeeze the business until one delayed payment is enough to push everything over the edge. That's what makes this industry so deceptive. If someone tells you they run a construction company doing $10 million a year in revenue, you'd probably assume they're wealthy. But after paying for labor, materials, insurance, fuel, subcontractors, financing, and countless overhead costs, they might keep only around $200,000. That's the illusion almost everyone gets wrong. But that's only part of the story. Later, you'll see why a small number of construction companies consistently earn far higher profits than everyone else. So how can a business move millions of dollars, employ dozens of people, and still leave owners constantly worrying about cash? To answer that, you have to understand the real economics of owning a construction company. Construction sounds simple from the outside. When a project, hire workers, buy materials, finish the job, collect the check, and repeat. But that's almost never how the money actually moves. The first lesson every successful contractor learns is that revenue and profit are completely different worlds. A company can build $10 million a year and still struggle to make payroll because invoices don't pay themselves. In many parts of the industry, healthy net profit margins often land somewhere between 1.5% and 5%, depending on the type of work, the market, and how efficiently the company operates. That means every dollar matters. One estimating mistake, one delayed project, one lawsuit, or one unexpected material price increase can erase an entire year's earnings. That's why experienced owners spend far more time watching cash flow than celebrating revenue. Revenue looks impressive on paper. Cash is what keeps the doors open. Imagine a contractor who just landed the biggest project of his career. The contract is worth $10 million. Friends think he's finally made it. New trucks arrive. More workers are hired. The company has never looked busier. But just 6 months later, he's borrowing money simply to make payroll. So what went wrong? Imagine 3 companies bidding on the same project. One bids $10.5 million. Another bids $10.1 million. The last company bids $9.6 million and wins the contract. Everyone celebrates until unexpected costs begin piling up. Months later, the company realizes it didn't win a profitable project. It won an expensive mistake. It gets even harder because construction is one of the most competitive industries in America. Most projects aren't awarded to the company with the best marketing or the nicest website. They're won through bidding. Multiple contractors study the same plans, estimate their costs, and submit prices. The owner often chooses the lowest qualified bidder. At first glance, that sounds efficient, but economists have a name for what frequently happens next: the winner's curse. Sometimes the company that wins isn't the one that found the smartest way to build the project. It's the one that underestimated the cost the most. By the time construction begins, that contractor is already locked into a contract with razor-thin margins. Every weather delay, design change, or labor shortage pushes the project further into the red. Winning the bid can actually mean winning the opportunity to lose money. Estimating those costs is much harder than most people realize. Imagine paying a worker $25 an hour. Most people assume the company's labor cost is exactly $25 an hour. It isn't. Payroll taxes, unemployment insurance, workers' compensation insurance, health benefits, retirement contributions, paid leave, training, and administrative expenses all stack on top of the wage. In many cases, that $25 employee can cost closer to $36 an hour before producing a single dollar of revenue. That's called the fully burdened labor rate. And it's one of the biggest reasons inexperienced contractors underprice jobs. They calculate wages instead of total employment costs, and the missing dollars quietly eat away at every project. Thousands of new contractors don't fail because they can't build. They fail because they accidentally priced the job for profit, but paid for it at a loss. Then comes equipment, another area where appearances can be misleading. Bulldozers, excavators, cranes, loaders, and trucks are incredibly expensive assets. A contractor can purchase them outright, finance them with loans, or lease them. Owning heavy equipment sounds like a sign of success, but expensive machines only make money when they're actually working. A $500,000 excavator sitting in the yard isn't earning a dollar. It's still costing the company money through loan payments, maintenance, insurance, and depreciation. Neither choice is automatically right. The smartest companies match financing decisions to their workload, expected utilization, and long-term strategy instead of buying machines simply because they look impressive sitting in the yard. This leads to the biggest misconception about construction. People think the business is about pouring concrete or raising steel. In reality, those are just the visible outputs. The invisible business is financial management. Every successful contractor is constantly balancing labor costs, equipment utilization, insurance premiums, bonding capacity, supplier relationships, tax planning, scheduling, and financing decisions. The building is only the final product of a much larger financial system. Now, imagine it's Friday morning. Your workers expect their paychecks today. Your fuel supplier needs to be paid. Equipment loan payments are due. Subcontractors are calling for their money. Everyone expects to be paid on time. But your biggest customer won't send a single dollar for another 60 days. Now, imagine you've finished part of a project. You send an invoice expecting payment, but the money doesn't arrive next week. It might not arrive next month either. Many commercial contracts operate on net 60 or even net 90 payment terms, meaning contractors wait 2 or 3 months before receiving cash. To make things even tougher, owners frequently hold back retainage, often around 5% to 10% of each payment, until substantial completion or even the very end of the project. During that entire period, the contractor has already paid employees, purchased materials, rented equipment, covered fuel costs, and paid subcontractors. Money leaves the business long before it comes back. That's why construction has one of the toughest cash conversion cycles in the economy. Think about the pressure that creates. You may have millions of dollars worth of work underway, yet your bank account keeps shrinking while you wait to be paid. If another project starts before the previous one has generated cash, the gap grows even larger. Owners often rely on lines of credit just to bridge the timing difference. On paper, the company looks busy and successful. Behind the scenes, it's borrowing money simply to keep operating until customers eventually pay their invoices. Public construction projects add another layer of complexity. Roads, schools, bridges, military facilities, and government buildings often require contractors to obtain surety bonds before they can even compete for the work. These bonds aren't just paperwork. Before backing a multi-million-dollar project, surety companies carefully examine a contractor's financial strength, experience, cash flow, and track record. In other words, if your business isn't financially healthy, you may never even get the chance to bid on the biggest and most stable government projects. Safety creates another financial dimension that outsiders rarely consider. Construction is one of the most dangerous industries, and one serious accident can become incredibly expensive. Beyond the human cost, accidents can lead to lawsuits, higher insurance premiums, project delays, damaged reputations, and lost future contracts. Companies that treat safety as part of their culture usually spend far less than companies that ignore it. Even after a building is complete, the risks don't necessarily disappear. Years after a project is finished, serious construction defects can still lead to costly legal disputes, insurance claims, and expensive repairs. In construction, finishing the job doesn't always mean the financial risk is over. That's why quality control isn't just about customer satisfaction. It's also about protecting the business from future liabilities that can appear long after the final invoice has been paid. Imagine 2 construction companies. Both have completed $1 million worth of work this month. On paper, they look equally successful, but there's one major difference. The first company has already collected most of its money. The second company is still waiting to get paid. One is preparing for the next project. The other is wondering how it'll make payroll. Inside every well-managed construction company is a report few people outside the industry ever hear about. The work in progress schedule, usually called the WIP schedule. It may sound boring, but it can determine whether a company survives. The WIP schedule helps owners compare the work they've completed with the money they've actually billed and collected. It quickly shows whether cash is keeping up with the work or quietly falling behind. The healthiest companies monitor these numbers constantly because cash timing matters just as much as profit itself. History offers powerful reminders of what happens when these financial disciplines break down. One of the most dramatic examples is Carillion, once one of the United Kingdom's largest construction and outsourcing firms. The company reported enormous revenues, managed major infrastructure projects, and appeared to be thriving. From the outside, Carillion looked unstoppable. It was winning major contracts, employing thousands of people, and building some of the country's biggest infrastructure projects. To investors, customers, and even many employees, everything seemed to be going exactly as planned. But beneath the surface were aggressive bidding, overly optimistic project estimates, mounting debt, and contracts that generated far less profit than expected. Eventually, reality caught up. The company collapsed under billions of pounds in liabilities, leaving suppliers unpaid, employees without jobs, pension funds under pressure, and government scrambling to finish unfinished projects. It became one of the clearest examples of a lesson every construction owner eventually learns. Revenue can create the illusion of success, but cash flow and disciplined execution determine whether a business survives. Now compare that with companies that consistently produce stronger margins. Some contractors have achieved operating margins around or above 10% by refusing to compete solely on price, carefully selecting projects, maintaining disciplined estimating processes, and controlling execution. The lesson isn't that construction can never be highly profitable. It's that profitability comes from systems, discipline, and strategic positioning rather than simply working harder or winning more bids. By now, it might sound like construction is simply too difficult to make serious money, but that's only true for companies that play the game the same way as everyone else. The most successful contractors don't just build projects better, they build a better business model. That brings us to the 4 wealth levers that separate companies that merely survive from those that build lasting empires. The first is vertical integration. Instead of paying someone else for critical services, larger firms begin owning pieces of their own supply chain. They may operate concrete plants, asphalt facilities, fabrication shops, trucking divisions, or equipment fleets. Instead of paying outside vendors, more of the value stays inside the company, improving margins while giving management greater control over quality, scheduling, and availability. Think about it this way. Every time a contractor pays another company to supply concrete, transport materials, or rent equipment, part of the profit leaves the business. But when those services are owned in-house, that profit stays inside the company instead of going to someone else. Over hundreds of projects, that difference can add up to millions of dollars. The second lever is government infrastructure work. Private development rises and falls with the economy, interest rates, and real estate cycles. Public infrastructure spending follows a different rhythm. Roads still need repairs. Bridges still require maintenance. Schools and water systems still need upgrades. Contractors with the financial strength and bonding capacity to compete for these projects often gain a steadier stream of work that helps stabilize the business during economic downturns. That consistency becomes a huge advantage. While private projects can disappear during a recession, government infrastructure often keeps moving forward. A steady flow of work means steadier cash flow, fewer layoffs, and a business that's better prepared to survive economic downturns. The third lever is prefabrication and modular construction. Rather than building every component outdoors where weather, labor shortages, and site conditions create delays, companies manufacture portions of the project inside controlled factory environments. That improves consistency, reduces waste, shortens installation time, and allows more predictable scheduling. In an industry where delays destroy profits, shortening construction timelines can dramatically improve financial performance. Think about the financial impact. Every extra day a project stays under construction means more labor, more equipment costs, more overhead, and more opportunities for delays. By finishing projects faster, contractors don't just save money. They get paid sooner, free up their crews for the next project, and turn the same resources into more revenue over the course of a year. The fourth, and perhaps most powerful lever, has little to do with construction itself. Many successful builders eventually begin developing and owning real estate instead of simply constructing it for other people. Imagine building an office, warehouse, apartment complex, or retail center that you own after completion. Instead of collecting a one-time construction profit, you now earn rental income for years or even decades while the property itself may appreciate in value. Construction becomes the engine that creates long-term assets instead of temporary projects. This is where the business model changes completely. Instead of getting paid once and moving on to the next project, the contractor now owns an asset that can keep generating income month after month. Over time, those rental payments and the property's increasing value often create far more wealth than the original construction profit ever could. Some of the wealthiest people connected to the industry didn't become rich by building buildings. They became rich by owning what they built. When you step back, a completely different picture of construction emerges. It's easy to admire the cranes, the skyscrapers, the highways, and the massive job sites. But the true business exists inside spreadsheets, forecasts, contracts, insurance policies, cash flow projections, and risk management decisions. Every project is essentially a financial puzzle where dozens of moving pieces must align perfectly before the owner earns a meaningful return. That's why so many people misunderstand this industry. They see millions in revenue and assume millions in profit. They see expensive equipment and assume enormous wealth. They see crews working everywhere and assume the owner is making money every single day. The reality is that construction rewards precision far more than size. A smaller contractor with disciplined estimating, healthy cash flow, strong safety practices, and carefully selected projects can outperform a much larger competitor chasing revenue at any cost. In the end, construction isn't really a building business. It's a cash flow and risk management business that happens to build things. The companies that understand that distinction survive economic cycles, expand into new markets, and create lasting wealth. The ones that chase revenue without mastering the financial side often discover that bigger projects simply create bigger problems. And that's the lesson behind the $10 million revenue illusion. Revenue attracts attention, but disciplined financial management is what creates lasting success. Once you start looking at businesses this way, you'll realize construction isn't the only industry where huge revenue hides surprisingly small profits. Shopping malls create the same illusion in a completely different way. Click the video on your screen, and I'll show you how they really make money.